Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Steve, thanks for taking some time to join me, mate.
Anytime, Owen. Good to be here.
Yeah, today we're going to be talking about value investing. We're going to be talking about valuation. I realize it's not something that we've actually spoken about in detail, but who better to do it with than someone that's been doing it for a long time professionally, talking about it for a long time, and also as a CFA charter holder.
And getting it wrong time and again as well.
We'll talk about that, yeah. But that's part of it, right? So maybe the first question is just, what is value investing?
Well, I think the question relevant to that is, what is value? And for me, that's actually a really simple question to answer in theory and a very difficult one to answer in practice. Yeah, the value of any asset, really, and this is not just applicable to shares, is the value in today's dollars of the cash that investment is going to generate over its life. So if we look at shares, you would say, well, that's the dividends that this company is going to pay me from now until time eternity. If you looked at property, for example, that's the rent that company is going to pay you, that house is going to pay you forever, and you just discount that back to today, and that is the value of a security. And in theory, that is the interesting thing about it, is it's impossible to go wrong. You buy it, you hold it forever, you're going to earn the return that you discounted those cash flows back at, if that security generates the cash flows that you expected. And that's where all of the complexity comes in, particularly in equities land. Estimating how much profit a company is going to make is hard enough. Overlaying that with the added element of, well, how much am I going to get back out of this investment as an investor, creates huge amounts of uncertainty. And that's where all of the insight in this business comes from.
So I think you once said that it's probabilistically, that's how you want to think. And that's probably that if, right? Like if this, what's the percentage did you ascribe to that thing happening? Is that how you think about it? Like in terms of like the if is the hard part to get to wrap your head around. Like everyone can do a DCF or everyone can do this, but that's the point of difference for each analyst.
Yeah, and I think if you're sitting there with a spreadsheet and you're putting all these numbers in, it creates this impression of some sort of certainty about it that is just not right in the real world. And I think one of the other mistakes that a lot of people make is they're actually doing a DCF on the company and not thinking enough about the DCF on the security itself, i.e. what am I going to get out of this rather than what's the company just going to make? Because that element of it, how much is coming out, it doesn't have to be high. Right? Berkshire Hathaway is zero and it's been zero for 60 years and it's been a wonderfully successful investment because they have retained all of that money and they've grown their capacity to eventually pay you more cash down the track. So it doesn't have to come out to you, but if it's not coming out, then you need to spend a lot of time thinking about what return is this company going to earn on the money that it keeps, because what I'm giving up here is cash today for cash tomorrow, and that can be very, very heavily influenced by what the company does with it. So already you're thinking about a complexity there that, okay, is this a big dividend paying company where I'm just getting that cash back out of it? Or is it something where I need to spend a lot of time not just thinking about the business, but about the capital allocation of that business over time, because they're keeping almost all of the value here is going to come from this company reinvesting my cash over years rather than me getting it in the form of dividends.
I think a lot of people that are new to investing don't really understand that aspect of it. Once you've studied it, you realize what you're actually valuing to. So are you valuing against the equity, like as an equity holder? Are you valuing it from the firm's perspective? If you're reading a CFA textbook, particularly level 2, it goes into detail about free cash flow to firm or free cash flow to equity being they seem similar, but their subtleties are important. How about then if we switch gears, if something doesn't pay cash, how does it have value? So for example, like artwork, right? It doesn't pay you anything, but yet people still pay it a lot of money for these types of things.
Well, could you rent it out?
would probably.
So does that piece of art that you have bought have a value if you wanted to extract a value for it by renting it to people, and that comes from its worth? But I think you are generally then getting into an area of speculation rather than investment. If it is, I'm only buying this because I think I can sell it to someone else for a higher price, that's the distinction between investing and speculation. And there's nothing wrong with it. Plenty of people are very, very, very good at speculation, and you can make lots of money from doing that. But for me, that distinction is really important. I call it my fallback. We're all buying stocks thinking we're going to sell it to someone else for a higher price, right? That's the honest truth about it. And anyone that tells you different is lying to you. We get paid for generating outperformance of the market to our clients. But the whole premise behind value investing for me here is I've got a fallback that says I don't need to sell this stock to someone else if the price has gone down, because I have bought something that's paying me cash over its life. And if I hold it forever and I was right about those cash flows, I'm at least going to earn, if I've used a 10% discount rate, I'm going to earn my 10%, even if nobody ever wants to pay me a premium price for that. Now, more often than not, they do, because the whole market is a battle about what those cash flows are going to be. But that's the really important distinction between me. I'm buying this with a fallback plan here. Obviously, I think other people are going to value it more highly in the future, but my fallback is I own it forever. And that's how I think about value investing and investing in general.
There's a couple of valuation methodologies that I'd like to just jump over. The first is ratio analysis, in terms of using, well, not maybe even so much ratio analysis, but more multiples-based approaches to valuation. So things like price-earnings ratio, which is very common, price to sales, et cetera, et cetera. I guess there's two questions here. Do you use these? And if yes, why? If no, why?
Yeah, so I would say all of those things that you're talking about are heuristics which are shortcuts for estimating the actual cash flow that it's going to provide you with over its lifetime. And sometimes I think those heuristics are better able to be roughly right than your complicated spreadsheet. So yes, I use them, and I always use them as a sense check. Anyone who's built a DCF model will realize that you put in a 6% discount rate and a 5% growth rate, and you're going to get a very stupid answer that comes out of that. So I like to have a fallback with multiples, while never forgetting that what I'm focused on is the cash flow of the underlying security. The multiple can be a shortcut to that. And if you take something like price to book, for example, you're saying that this is a business that has a whole lot of assets here, and I'm buying the business for less than the value of those assets. So you could say, okay, there's a form of valuation there that says that you're getting it cheaply. I would always say, well, what cash flow are those assets going to generate for me? But that price to book is actually a useful way of saying, well, in an efficient world where companies compete and there's a return on capital required, I may not be able to exactly estimate how much profit this company is going to make over the next 5 or 10 years, but I can use a rough rule of thumb to say it's going to earn an average return on its assets, and therefore it may be worth the amount of assets that it's got, or more or less. But it's a nice little, I guess, anchor for your valuation to say what might make sense here. If it's in a competitive industry, if it doesn't have a huge competitive advantage, if those assets are being replaced by other competitors, it's actually easier sometimes to hang your hat on the book value than it is to say, well, okay, this oil and gas company is currently not making money at the current oil price, right? It's really hard for me to work out what's the oil price going to be, when's it going to start making money. But if you stand back and you say, well, over a 10-year cycle, nobody is going to invest more money in oil assets than when the current assets are not making a profit. So I use price to book to say, well, people will ultimately be rational here. The price will go up, has to go up to a point that incentivizes people to invest. And at that point, this company might be worth its assets. But I'm always still thinking, what's the cash that comes out? And I think it's the main... I don't actually agree with the term value trap. This idea that, you invested in something and the market never realized the value of it. Right. The honest truth is you invested in something that never paid you the cash flows that you thought it was going to pay you, and that's why the market never realized the value. So it wasn't a value trap. It was you getting the value of that business wrong. And, I look at say MRM. We don't own it anymore. But for 3 or 4 years, we owned an oil services company that owns a significant number of vessels. And if I go back to the valuation of that business now 5 years ago, and I say, well, okay, we're buying this for a 30 or 40% discount to its book value. Within 3 years, it's going to be back to earning an appropriate rate of return on those assets. And that just hasn't happened. So you can sit there and say, well, it's still trading at a book value, therefore it's a value trap. Or you can say, we got that wrong. We overestimated the capacity for that business to recover. So I actually really like the heuristics. I think they give you a really simple shortcut, but it's important to understand why you're using it and what is the link between that heuristic and the cash that you're actually going to get out of the security over its life.
I think it's Bruce Greenwald that talked about this in one of his books. I can't remember if it was, I'm going to butcher it, but maybe it's Value Investing, where it talks about rebuilding a balance sheet to understand. So like reconstructed balance sheets give you a sense of the value, as in like the capital that would be required to replicate this company. Do you ever do anything like that where you just build it, say, okay, this is the property, plant and equipment has been depreciated at X, the current value of that is Y. Do you ever do anything like that?
Not so much anymore. And I think we've moved into a world where A, the accounting value of these assets is very spurious to start with.
Yeah.
And B, the value of most companies is less linked to its physical assets than it has ever been before.
Yeah.
I think that's just a reality of the world that we live in and the way that value is being created these days. I still love building out a profit and loss and a balance sheet to some extent, just to try and understand how the cash is going to flow in the business. Is it going to need more working capital as it grows, for example? You've got a business that's growing nicely and is profitable but needs all of that money to continue to grow because it chews up working capital, or is it the opposite? Every time Woolies opens a supermarket, they sell everything that's in there before they pay for it. So it actually net generates cash for them to go and open a new supermarket. That's a very different business from one that requires that cash to unfold. So I do like trying to just model that out. I still actually like taking a balance sheet out of an annual report and recreating it in a spreadsheet and just putting the numbers in myself, because it just gives me a much better feel for what's actually going on there, and it just makes me go through and have a look at each of those items.
Switching gears, how would you value a bank? Would you use like multiples? Would you use something like a dividend discount model? If you're going to value something like that, what's the kind of the 30,000 foot view of that process?
I would say that depends on what point in the cycle it is at.
Right.
You should be able to use both of those things and get roughly the same answer. And I think that's when you know you've got the right sort of heuristics here, the book value, I'm paying a certain level of it here. I think it's a particularly interesting question for banks in the current world that we live in, where the political and social license that they have to give capital back to shareholders has been eroded very significantly. So we own Lloyds, which is UK's largest bank in our international fund. It has a Tier 1 capital ratio, so the amount of capital it needs to hold against all of its assets, of 17%. Its regulatory minimum is 11 and its internal minimum is 3. So they've got 4% of excess capital there, which is something like 30 or 40% of the company's current market cap. So theoretically, they could give you all of that money back and they would still have plenty of capital to run the business, and they'd still make as much profit as they make at the moment. It's just lazy money that's sitting there. We live in a world where that's really, really hard to do. We gave you support through the financial crisis. We gave you support through COVID, and now you're turning around and paying fat, rich shareholders dividends. It's become really difficult. And I think that's become a new piece of the analysis of that bank is, okay, it's going fantastically well. It's making lots of profits. They've got an enormous amount of capital, so the business has never been safer than it has. But when and how are we going to get that out as shareholders? It's become a difficult question. So, I think the old rules that I would have applied there 10 years ago need to be thought about a little bit differently in terms of, I'm probably applying a discount to book value for those businesses just for the excess lazy capital that they have to hold.
See, I noticed that if I was to say do a dividend discount model on Australian banks, I can really only find the valuation, the discount to intrinsic value if I use the franking credits, which is interesting because but you would expect that, right, for it to be within that plus or minus 20% of the intrinsic value based on probably quasi franking credits, because that's the value to Australian investors, I guess.
Yeah.
How about then if we switch gears again, something the concept of like SaaS metrics. So software as a service, we've got things like average revenue per user, churn rates, lifetime value. Do you use any of that stuff?
Yes.
Yeah.
Yeah. Again, as very, very useful heuristics.
Yep.
I still want to know when the cash is going to come out of it.
Yep.
And I still think people are being wildly, wildly optimistic about how quickly and how profitable these companies that are not currently profitable become so. And we're an investor in a few of them. So we own Whisper in our Australian fund.
Yeah, I did see that. Yep.
I'm quite excited about that one, but it's a huge uncertainty in our valuation model as to how much profit that company is going to make. When I'm really confident in the growth, but is that margin going to be 10%, 20%, or 30% in 10 years' time? That when I look at our valuation, this is something that I spend a lot of my time doing now as CIO, is saying, what are the key assumptions here? Okay, you've built a model, whether it's a PE model or a price to sales model or it's an actual DCF model. You've built a model here that has a certain number of assumptions in it. Which ones of those do we have lots and lots of evidence for, feel really confident about? Which are we less confident about, and which are important in terms of if I change this or if I'm wrong about it, it's going to have a huge impact on the value of the business. And I think in all of those companies, that is this going to be Adobe and it makes 40% profit margins at maturity, or is it going to be something that constantly has to keep spending money to acquire new customers? And that's why for me, churn, having run a subscription newsletter business.
Yes, we talked about that once before, yeah.
Churn is a thing that people don't think enough about in the software space. I think Nearmap is a really good example of that. Even if you're only losing 15% of your customers a year, you double the size of that business and all of a sudden you need to find twice as many new people just to replace the people that you're losing every year. Yeah. If you're Whisper and you're 105, 110%, they put a really nice cohort analysis graph in their presentations. You can go back 10 years and you can see that, okay, these people that they signed up 10 years ago, they're actually spending more today than they were spending 10 years ago. For me, I've got good confidence that business can keep building on that and growing. I don't have a lot of confidence about how profitable it's going to be at the end of that period of time.
There is an interesting kind of, I guess they don't describe themselves as competitors, but they're kind of fishing in the same pond, which is Twilio, which is the US kind of a beast over there. And then you've got Whisper here. For those that don't know, there's like communication platforms you can plug in, and you can basically, if you're an enterprise, you can plug into Whisper and send and receive emails, or send your customers emails and then send them a text message and all those types of things.
Yeah,
right?
Anyone getting messages from the health services in Australia about COVID and things at the moment, that's probably being run through Whisper service. So it's a really good way of thinking about it. Okay, we've had an outbreak at a bar. We've got to message all of the people that were there that there's a whole, there might be 20 different groups of people within that group. Some are close contacts, some are casual contacts. They all need to do different things. And they've got this system set up that would plug into Queensland Health or Health Victoria and say, okay, we've had an event, click the button, sends the text message, and everyone gets the information they need. So they've been historically very heavily text dependent. Now they're building that out into email and a whole heap of other client communications thing, but text has been their growth engine for a long time. And
Twilio is a US business that's bigger, but it's more, I would say, from my understanding, it's more developer focused, whereas Whisper can be more enterprise focused in terms of here's the solution, we've got it for you, whereas people build into Twilio, which is probably a slightly different thing. Yeah. Then this brings up, on the topic of valuation, this brings up an interesting one. How much do you look at competitors to get a base case for, say, like margins for Whisper?
Yeah, a lot, but that space is difficult because none of them are yet at a scale. So I try and come up with what is the most similar business characteristics-wise that is mature. Right. But then I also think management has a few huge... honestly, a lot of these new tech businesses, I don't think they need to spend anywhere near as much money as they're spending, and they could still grow the same. And I think as the taps are turned off around capital, they've been able to raise as much money as they want at very, very high prices for their businesses. I think as those taps are turned off, you're going to see a lot more discipline around where the money gets spent. So, even if you find a similar business and it's earning much higher margins, you still need to make the call about what is this management team, and is it even the right thing to do? Like, I actually don't want Whisper turning the taps off yet and causing any harm to the growth of that business, because I still think even at the rate they're spending today, they're adding a lot more value to the business every year than the losses that we're making. So it's not necessarily that I want them to get there in a hurry, but I definitely, what are the characteristics of this? Is this a Hansen style business? We know that it can make 28, 30% EBITDA margins. Is it more an Adobe where there's even less below the gross margin line expenses, because once you've built the software, you literally have marginal costs of almost zero every time you sell it. Hansen still has a lot of care and customer work that goes into them generating revenue. So that's always going to be a lower margin business than Adobe. And I find that gross margin line is actually really useful. And Whisper's a good example, I think, of a lower gross margin business because they pass on a lot of their revenue to Telstra or to whoever's sending the text messages. So it's not the same as a pure software business where your incremental margins are close to 100%.
Yeah, I think that's a good point, is to extract, based on what you said before with the assumptions, and then you've got the margins, is trying to extract the essence of what the business is. What are the key inputs and assumptions into this model? And then how do you kind of fact check those against some sort of reasonable base, whether it's a like for like business or whether it's a business that has similar things, like maybe at the gross margin, it pays away some of that margin for resellers or server costs or whatever. So obviously we're taught as analysts that the silver bullet to value investing is discounted cash flow analysis, or DCF for short, which is basically the present value of future cash flows. You forecast those out. Typically, the way analysts do it, at least from my understanding, is we basically rebuild an income statement. We forecast things like revenue, margins, all that sort of stuff. And then we chuck it into our fancy formula, which gets us to something called enterprise value. When you've got the team, do you require discounted cash flow analysis from everyone in the team that pitches an idea?
Yes, for ideas where I think it is useful and warranted.
Okay.
And there are examples where it's the case is built around something different, or where I think if there's not a lot that's going to change in terms of margins or growth rates, then the old multiple heuristic is going to do a perfectly good job. I've seen enough of them to say this sort of DCF is going to look like a 15 times earnings business, right? That's where we know we're going to end up. So what's the point of spending 3 weeks building it doesn't take that long, but we build really simple models just so we understand where the cash flow is going to go. And we take one step further down from what you're talking about and saying, well, how much of that profit is going to get paid out as dividends,
right? And
how much is going to get retained by the business to grow. And that makes you think about a business that's going to grow at 10% per annum and keep all of your money is worth roughly 10 times earnings if you want a 10% discount rate. A business that's going to grow at 10% per annum and pay you out all of the money, you can pay 30 or 40 times earnings for and do really, really well out of it. So does this company need capital is an important piece of it. And we never bought the stock, but I'm a big fan of this company called Softcat over in the UK that has a 100% payout ratio. It's a tech services company, and because it has negative working capital, it's also been able to grow very healthily over a long period of time. And that's as rare as hen's teeth if you find it and hang on to it, because most companies, even if they could pay out all of their earnings, they just don't. They just keep it and the money gets frittered away, and you do need to think about that. So I make sure we build the models down to cash paid out.
Yeah.
And you can have a value for something that's not paying any money out again, but you need to think about that assumption becomes a really important one. Whereas with Softcat, I do not, there is not a, how are they going to allocate the capital is the least important question about how you value that business, because they're just giving it all back to you.
Do you calculate return on invested capital for your businesses? Yeah.
Yeah. And again, it's a qualitative check around, what are my assumptions here as this, if this business has earned an 8% return on its capital for the past 20 years, and I've got a DCF model that shows in 10 years' time it's all of a sudden earning 40% on its capital, why is that? If it hasn't happened for the past 20 years, why would I expect that it's going to happen in the future? And I think it's the mistake a lot of people make, is that the further out you get in your DCF, the more unrealistic the assumptions become about either spend per person or, I love just going back to, well, what is the market for this company? How much do people spend in the industry? It's really easy with compound growth rates to end up in 10 or 15 years' time with a business that in your model is generating more revenue than even exists in the whole entire market. So I do like to think about total addressable market. I do like to think about historical returns on capital and say, well, is our model getting out of whack here in terms of what's reasonably possible?
I find that in particular, new or aspiring investors and analysts really think of this as a scientific process. So they really think there's a black box and someone's keeping it, and only those that, have access to it can accurately value companies. But I think more time that goes past, the more I hear this kind of conversation from professional investors is it's more so about kind of the simple stuff that can be the most important, rather than say if you plug in this terminal rate or that terminal rate. Speaking of, I will get into the weeds on this. How do you select discount rates or expected rates of return for the companies you're valuing? Like, is there any type of process you apply, or is it just purely case by case based on intuition?
No, it's sort of just pretty consistent, to be honest with you. We just plug in 10.
Yeah.
We think we should, as a business, be able to generate double-digit returns for our clients. So we use 10 in our models, and then we want a hefty discount to that. I would say I tend to adjust the discount that I want depending on the risk of the situation more than the discount rate.
Right.
So I use Tesco as a good example at the moment. I'd still put a 10% discount rate in terms of how we value that business. It probably comes up with a price that's 20% higher than the current stock price. I still really like that in my portfolio at the moment, because it's a 12% IRR to flip that valuation around to say, well, what return am I going to get here if I buy it at a 20% discount and I'd used a 10 discount rate, then I should get 12 or something like that over the life. And it's a really safe business where the cash flows are reliable and predictable, and I just don't need to stress about what's going to happen with the economy and all this other stuff. You come to me with something that's small and illiquid and highly variable, we're looking at 50 and 60% discounts because we know they come along in that space. The more variable the business is, typically the more variable the stock price is. So if we're patient, we will get those opportunities. And B, I'm factoring that risk into the price I want to pay rather than the way I value the business.
Yeah, I love this idea that depending on what type of investor you are, if you're a long-term, say like high growth investor, I think the way that we define risk from an academic perspective is kind of myopic in terms of volatility, weighted average cost of capital. I think that's important, but I think the more important features, and this is where it takes time to get that pattern recognition, to understand business models and how they can come undone. I think a better way of thinking about it is from more like a qualitative perspective, where you do your research and you understand the intrinsic characteristics of a business. So things like, what's its competitive advantage, and however you define that. What's the management team like? Like, something that had never factored into academic models is how good is the management team? When you think about it, well, at least when I think about it, that should be like one of the first things when it comes to risk. Like, how good are these managers at allocating capital?
Yeah.
I feel like that's, and maybe it's a purist way to look at it, but I feel like that's, from a long-term investing perspective, I feel like that's a more reliable indicator of risk.
Yeah, and for me, I guess that all comes back to what is the chance that I'm wildly wrong here on my valuation, so that those cash flows don't work out the way that I anticipated, and that my net present value of those cash flows is less than the price that I pay. What is the chance of that happening? And I think the more variables you bring into it, so back to our, is it paying out the money or not? A company that's paying out all of its cash flow, that management, what are they going to be doing in 10 or 15 years' time? It becomes far less important than a company where they're keeping all of the money and you're completely dependent on their skills. So that's the definition of risk for me, is what's the chance that I'm wrong here? And what might go wrong is completely different on a situation-by-situation basis. It's the type of business and the management team and the capital allocation policies, and all of these things can change. You can think you invested in a great management team and you wake up in 5 years' time and someone's moved on or someone's died or, who knows what happens, and the culture in the business has changed. So you can be wrong on all of those things, and what we try and do in terms of risk is try and understand the impact of being wrong and what's the likelihood of that meaning I end up with a lot less cash flow here than I otherwise would. And Tesco's management made an absolute meal of things 10 years ago, but I think now, because of all of those mistakes of the past, there are dozens and dozens of people that could do a really good job of professionally running that business, because it's now become almost a business case study about how to run a supermarket well. It's not hard. It takes a talented person, but there's lots of those sorts of talented people out there. The management, Terry Leahy, that got it into a lot of trouble was a very entrepreneurial, we're going to buy this, we're going to grow it, and he had a huge number of supporters. They were wrong about that, and the people that bought the stock were wrong about the cash flows that were going to come out of it because of him and his management team.
I've got just one more technical question, and then I might ask for a bit of humility here. But the last question is, one thing where people get tripped up is the terminal growth rate. So this is the growth rate, for those of you that have never done this before, this is the rate that investors assume past, say, 5 years or 10 years, whatever your forecast window is, you have to assume some value to a company in the future. And the way we principally, as an industry, get to that is we say, at, say, year 10, the company's going to grow at 3%. Its cash flows at 3%. But that in itself is an incredibly sensitive variable to plug into a model. How do you deal with something like that?
Yeah, I'd just try and be conservative. And again, I'd start using heuristics as soon as you get out that far, rather than a 6 discount rate and a 4 growth rate, and I'm putting it on 50 times earnings, because that's what those two things work out at. I want, within the foreseeable future, I want the business to be, if I'm buying it cheap, it should look cheap on fairly traditional heuristics within a decent period of time. So I tend to just put something into that model out far enough that is just a sensible multiple. And if it doesn't stack up at that, then there's just not enough margin of safety in the business. Having said that, I think one of the great opportunities in the world is when you identify a business that can grow at high rates for long periods of time. Every single investment bank DCF in the world goes 5 years of high growth, and then it's going to go back to 2 or 3% per annum, and we're putting it on a terminal multiple of 20 or 25 times. I think some of the greatest investment ideas you'll ever have are, that is wrong. I really think this business is going to grow at, and the power of compounding, if you keep growing at 10 and 15% per annum for a long period of time, it just adds up to something wonderful. And that's, I think it's a little mental model to keep in your head around, whether it's Cochlear or ResMed or whatever it was that people were looking at 20 years ago and saying, oh, it's 30 times earnings, it's expensive, because they're expecting that growth to tail off. It can be a source of wonderful returns, where that's the one variable you need to worry about, is how long can this growth go on for, rather than what does the next 3 or 4 years look like. And I think that's where your point before about having the addressable markets, getting that right, is so very important. Like, a lot of people underestimate in key growing industries how fast the industry is expanding, and then how things within that industry expand even quicker again. So just as an example, say we have like digital advertising, which is taking share from traditional advertising. But within digital advertising, then you have programmatic advertising, which is fully automated advertising. So then that's a faster growing industry within the industry that's already growing. And I think that's where a really interesting that's a really fruitful ground for those types of companies. And I think the total TAM there is also growing. The percentage of GDP that we're going to spend on marketing, because it is now accessible to thousands and millions of small businesses out there that were never really able to spend much marketing on. That's it. The world we live in is going to be one where there's more spent on marketing and less spent on other things in the economy. That's right. And that whole one-to-one marketing through digital platforms is very powerful, whereas in the past it was broadcast and it was one-to-many and it was very expensive and unattainable. There's one question that came from Raymond, who has hosted one of the Australian Investors podcasts before. He said, it would be great to get some examples of when you've sold a position if it was too expensive but it continued to go up, like if there were any lessons learned there. Well, I think the first lesson is you get a lot wrong in this space. I think if you can get that old truism, 6 or 7 out of 10 is good investing. I really think that is true. For me, most of the things that go wrong pretty early. There haven't been a lot of, I was wrong about this, and then all of a sudden it miraculously turns out to be right. And on the flip side, the things that have gone right for me have tended to keep going right. There are exceptions to that. Service Stream, one of our most successful investments, we sold it at $1.50. It got up to $2.30 or $2.40 at one point in time. It's now 77 cents or whatever it was yesterday. Okay. So that was an example of you maybe say we sold too early, but we were right about where the earnings for that business was going. As the NBN wound down, we were very nervous about its earnings. There are more examples of Jumbo Interactive for us that we sold at $5 or $5 $1.50 and it's now $18 a share. Even a Nero, which we still own, we've sold pretty consistently over the past 3 years, and it's now 3 times the price at which we first sold some shares. I would say we've been guilty of most of our successes selling them far too early. 360, another recent example over the past 12 months.
Is that because of valuation?
There are lots of them. Valuation, and I think if I'm to be critical of us, I think it's being anchored at an old valuation. So I think if you go into this exercise saying, okay, I am valuing these businesses, but it is highly, highly, highly uncertain. I'm certain to be wrong about what the value of this business is, and I'm going to update that valuation all the time. Now, you can be guilty of just chasing stock prices, right? I'm going to make up a valuation that works because I want to keep owning the stock. But we've been more guilty of just sticking to, this is a 15 times earnings business. The market's going to attribute that to it at some point in time because it's got these nice characteristics. Or in a Nero's case, it's a marketing services agency. Go and look at all the global comps. They trade 11, 12 times earnings at best. We're buying this at 8. Great. We've made 50% up to 12. Now it's a market multiple. Let's sell it. And underneath the surface, there was an ad tech business in there that was growing very, very, very quickly, talking about the advertising industry. We were worried about that as well. At one point, it wasn't making any money, and all of a sudden it's making $10 million a year and has become 40% of the company's profit. But it was also a potential transformation of that business from state-old marketing agency to ad tech growing. Why can't that be a 25, 30 times multiple for the business? So I think being quite dynamic around your valuation for these businesses is really important. And then the other thing, you touched on this earlier, but I think if you get a management team that is aligned and very good, don't underestimate how well they can navigate whatever environment comes your way. So, especially if they're retaining capital and they're deploying it. I think we're having some internal debate at the moment about Motorcycle Holdings, the motorbike dealership.
Right, okay.
I really like the guy who's running that business, and they are 11 or 12% market share in the motorbike dealerships at the moment. It's been a great year because of COVID, so everyone's saying COVID unwind, don't own the stock. It's not down much, but it's only trading at 8 times earnings because everyone's worried about the comp period. I'm really happy just to give him the leeway and say, you've got a lot of money invested alongside us. You know what you're doing. I'm going to let you navigate this period. And we're talking a lot about it internally because there's not a lot of big branches out there for them to buy. It's a bit of a consolidation business, but he's only 11% market share, and I think he will find a way to get to 25 or 30 here eventually. And I don't know what that path is, and I think that's the hard thing when you're sitting there and you want to build a DCF. How is this going to unfold? I don't know, but I'm pretty confident that it's the right sort of person to take us there.
Backing the jockey as well as the horse.
Yeah.
Steve, this is great. We did a deep dive into valuation. If people want to find out more from you or the team, they want to see what's in the portfolio from the latest monthly, where do they go to get that?
So it's foragerfunds.com, or you can follow me on Twitter at forager_Steve as well. And our monthly and quarterly reports, we don't go into this level of detail, but we do write quite a bit about why we own the stocks and a lot of these issues.
A lot of great companies in there too. So I'll provide links in the show notes to all of those. And just so I can be clear, people that invest with Forager, can they invest with as little as $5,000 plus a payment plan? Is that right?
I'll whisper this on, but we've never sent anyone's check back.
Okay.
I think it says $20,000 in the PDS.
$20,000.
But there's ongoing, if you sign up to monthly direct debits, you can do that for as little as $200 a month. And I actually think that's a really great way for people to build their wealth and not stress about the ups and downs of market movements. And we've actually got, she's off on maternity leave at the moment, but Alex Rudge, who's worked with me ever since we started Forager Funds, basically all the very early years anyway, she's built herself up a very, very nice investment in our funds just by doing, every time I get paid, I'm putting some money in, and the compounding effects really added up there over time. So I think if you're early on and getting started, we really like to encourage people to get started early. So we're a place that you can come and ask us a favor, and we usually say yes.
Well, I know. The reason that I asked is I know we've got one super fan in the office, so who's done just that. So that's why I bring it up. Mate, as always, it's a pleasure. Thanks for joining me.
Thanks, Owen. Great to be here.